Hello, everybody. Ed Yardeni here. Welcome. Thank you for joining me today. It's March 25th. March is almost over, and before you know it, it's going to be April. April showers bring May flowers, and we'll have Mother's Day, and before you know it, it'll be summer, and so on. Before you know it, the market will be at 5,400 by the end of the year. That's been my forecast, that the S&P 500 will get to 5,400 by the end of the year. Well, it could happen by the end of the week. The way this market's been going, and that's not an exaggeration. We've had an extraordinary bull market since really October 12th of 2022. We had a bit of a correction there last year, August, September, October 27th. We made a low in that correction, exactly 10.3%. So it was a very accurate correction, very typical correction. And then we rebounded off of that and went on to make new record highs. First in the S&P 500, led by the mega cap 8, led by then of course the Nasdaq 100 as well. The Nasdaq has joined the party as well as some of the other indexes. A lot of the sectors of the S&P 500 are at record highs. So it's been I think, a fairly broad bull market. I just saw today that somewhere in one of the financial media, a strategist was quoted as saying, well, this is not really a broad bull market at all. If you look at the ratio of the S&P 500 equal weighted divided by the S&P 500 market cap weighted, that ratio has actually been down. And isn't that clearly a signal that this is not a broad bull market? And the point I've been making is that you have to look at the details. You have to get into the weeds when you're looking at breadth, and you have to really see what's going on. And what's really going on is that a lot of stocks, a lot of sectors and industries are up only by puny double digits of 20%. And then there's some outliers that are up 40, 50, 60%. The S&P 500 is up 46%. So you know that there's got to be some pretty strong sectors out there that are leading the way. But it's only by comparison to the really strong sectors that it looks like it's not a broad bull market. 20% gain since the beginning of the bull market on October 12th, 2022 is a decent gain. And yet, when you do that ratio calculation, it looks like it hasn't been a broad bull market, but in fact, it has been. So it's all a matter of looking at the actual returns on at the micro level of industries and stocks and so on. So we've got a very good bull market here. Bull markets usually occur when investors aren't particularly concerned about the Fed raising interest rates. And for the past 6 months or so, investors have come to the conclusion, and the Fed has signaled that they're done raising interest rates. So now the big controversy has been, well, okay, so when are they going to start lowering interest rates? Because the history of federal funds rate peaks is that they may pause for a few months, but they don't pause for very long before they come tumbling down. And the notion, of course, is that they come down because the tight monetary policy with a lag causes a recession. Tight monetary policy with a lag causes demand in the economy to come off. And so the Fed has to lower interest rates because a recession occurs. And if it doesn't want to see a recession occur as we have right now, the Fed doesn't really want a recession because they think that inflation is coming down just fine on its own. They're absolutely right about that. It is coming down fine on its own. So why lower interest rates? Well, simply because past couple of years, we've had some real tightening of monetary policy from a zero Fed funds rate all the way up to 5.25%. Surely, with a lag, that restriction is going to cause a recession. And surely, real interest rates matter. If we got a 5.25% Fed funds rate and inflation is down to 3%, going down to 2%, And that means the real Fed funds rate is going to go up. And isn't that restrictive? And my answer to all these things is postmodern monetary theory, PMMT. And the simple notion is that what people are missing is what's plainly visible on the charts, and that is that most recessions were caused by monetary policy tightening, absolutely correct. And with the inversion of the yield curve, as investors start to conclude that if the Fed keeps tightening, something's going to break. So why not buy bonds at 4%, even though the 2 years is at 5%, because something's going to break. And sure enough, something breaks, as we saw. The banking crisis happened last year. And yet the Fed came in with liquidity facilities. And as a result, we didn't have the full process that leads to a recession. We didn't go from tight monetary policy to a financial crisis. We went there, but we didn't go to a credit crunch and we didn't go to a recession. So far, so good. And it's kind of unlikely that we're going to get a recession now with the Fed basically signaling that they are now concerned that about these restrictive lagged effects, and that maybe they have to start thinking about lowering interest rates to avert a recession. So the bottom line is the Fed put is back. Hip, hip, hooray. Let's all get excited. This is exciting stuff. The Fed is telling us that don't worry, if inflation keeps coming down, and I think it will, then the Fed may decide to move ahead and lower interest rates to keep a recession from happening. Of course, this is the recession that's been a no-show for the past 2 years, and the Fed would like to keep it as a no-show. And so again, from that perspective, real rates may be too high if inflation keeps coming down. And what about those lagged effects? Well, I've again, if you look at the charts, it's pretty clear that there is no such thing as lagged effects of monetary policy. What there is monetary policy tightens, and at some point in the past, we've seen a financial crisis, credit crunch, and a recession, and there's no lags in that process. Nevertheless, I'm not going to tell you it's the notions of lags isn't possible and may not have some relevance. It surely can. I mean, certainly in the commercial real estate market, it's going to take a while to overcome the problems that they have there. So there are long and variable lags, but I think when you add them up at the macro level, I'm rather skeptical. So now we got Fed Chair Powell's press conference last week, and what stood out is that he said several times that the Fed is committed to getting the inflation rate down to 2% over time. He said over and over again. In other words, what he was saying is that, trust us, when we get the confidence that we're heading in the right direction, that we're going to get to 2%, then we might very well start lowering rates without the inflation rate actually having to sustainably be down to 2%. He also mentioned a concern that, well, he didn't say it was so much of a concern. He just kind of raised the possibility that there could be an unexpected increase in the unemployment rate. Unexpected. He mentioned that a couple of times, and I think 4 times all told. And so what's that all about? And I think what it's all about is trying to, well, maybe it's all about getting an excuse for lowering interest rates, because the unemployment rate is 3.9%. The FOMC, in its summary of economic projections, basically concluded that the nirvana unemployment rate is 4%, 4.1%. So we're basically there. So it's conceivable that there'll be some unexpected event that will lead the unemployment rate to go up above 4%. But again, in the past, according to my homegrown PMMT, which is really not a theory, but it's fun. But the PMMT model says that, again, look at the charts, and what you'll see is absolutely the unemployment rate is always at a cyclical low before recession, and then in a recession it goes up, and it goes up sometimes very quickly. So, what is really unexpected there? What is unexpected is that tight monetary policy will cause a recession. And a recession means that there's a credit crunch. It does have an impact on demand. It does have an impact on reducing the demand for labor, for sure. And so the unemployment rate goes up. In the current environment, unless we get another financial crisis, we had one last year, and the Fed dealt with it very, very quickly in their Whac-A-Mole policy approach, creating emergency liquidity facilities. So are we going to have a situation where tight monetary policy with a lag leads to a recession that pushes up the unemployment rate? If not, then the unemployment rate is going to continue to stay right around here, and initial claims just keep hovering around 200,000. And if we do get into trouble for some unexpected reason, then the Fed, of course, will lower interest rates. So, I mean, for the stock market, this looks like a one-sided bet. The only problem with the market is valuation. The only problem with the market is everybody's bullish. So who's left to buy? Those are some of the issues that I've been grappling with. I'm sure you've been grappling with. But for now, it looks pretty good. And I asked Max before. Max is over there. Maybe you can see Bailey's on the other side of the desk there. But I asked Max. This is Max on the market. Max on the market thinks the market's going to go higher. So I told him all about the bull-bear ratio and all these other things. He thinks it's just going to go higher. So I may just have to go with him. But my problem is we're at 50. Year-end target is 5,400. We're almost there. That problem's easily solved. All I have to do is decide whether to keep it there or to raise it. And I am inclined to raise it. Instead of what I've been telling everybody is I think it's a long-term bull market. I think we're going to get to 6,000 next year and 6,500 the year after that. But this market just wants to move faster than my forecast. Last year, we were forecasting 4,600 at the beginning of the year. We got to 4,600 by the middle of the year. And then we closed the year around 4,800. So I got no problems with any of that. That's fine. It's certainly a positive reading on what the economic outlook is, and that's good for all of us. Well, let's go and share the screen here and take a quick look at some of the charts that are relevant to all this PMMT and other stuff. So let's look at Figure 1. There's the chart and that's PMMT. In one chart. It just shows that historically the federal funds rate tends to peak just exactly at the time when something hits the fan, when we get a financial crisis. Certainly, that's been the story since the 1960s. The pause in the Fed funds rate has occurred in the past, as you can see. Well, you see there's a pause over here. That was before the recession hit. But then when we had this financial crisis triggered by the Bear Stearns situation, the Fed started lowering rates. And by then, I guess you could argue that there were long and variable lags. But I would argue that it didn't take very long for the Bear Stearns crisis to turn into an economy-wide credit crunch, for some policy mistakes to be made along the way, like not bailing out Lehman. They could have fired Fold and all those clowns there and just kept Lehman alive, but they didn't. And I think up to then, the market was down something like 20%, so it was sort of a garden variety bear market. And then in early 2009, Larry Summers, who was going to be the consultant economic advisor to Obama, said that banks should be forced to pay de minimis dividends. And so guess what happened to the financials? They got whacked again. So there were a bunch of policy mistakes here, but it's the nature of the beast. We had LTCM here, and that didn't cause a crisis. This was an example of the Fed playing whack-a-mole and providing liquidity. There was another example of that in 1987. Let's see if we can spot that around here. Let's see, 1987 would have been right around here. So we had in 1987, we had the Black Friday meltdown in the stock market, and the Fed provided a lot of liquidity, a lot of support. So there have been incidents where we've had a financial crisis, 1998, 1998 and 1987, in which the Fed responded in a way that avoided a economy-wide credit crunch and a recession. But there have been plenty of other examples with that where that was not the case. So let's look some more here. This is the inverted yield curve. And again, I've said this over and over again. You're probably sick of hearing it from me, but there's still people out there saying, but the yield curve's still inverted. Yeah, so what's your point? It's been inverted for a long time, and so far no recession. I guess the point is the bond market seems to be thinking that maybe something will still break, and maybe it still makes sense to buy a bond at a yield slightly below somewhat below the 2-year. And if something breaks, if the Fed comes back with an emergency liquidity facility and that avoids a credit crunch, then it'll avoid a recession. So this is a very dynamic game we're in here. Business, I should say. Let's take it seriously. Liquidity facilities. Here's a simple measure of liquidity facilities. It's simply the Fed's balance sheet less its securities bought outright for monetary policy purposes. And so we had a big Whac-A-Mole game here. This is where they learned how to play Whac-A-Mole. So when we had the great virus crisis, they came in with liquidity facilities really quickly, and so we had a two-month recession and a very short bear market. Maybe there was 2 months as well, and a great opportunity to buy back then. And here again, with the banking crisis, we had a liquidity crisis, so they provided liquidity, and there was no recession because there was no credit crunch. History does show that in the past, it seems to have required recessions to bring inflation down. And I have the history of CPI inflation all the way back into the I think 1910s in this chart, and it's on a monthly basis. So it's a pretty good chart to see the history of these things. And again, you can see that I think there was after World War II, right here, you see that there was an inflation burst here. A lot of that was consumer durable goods because manufacturers were geared up to make bombers and tanks, not consumer durable goods. So when the soldiers came back and started household formation, the economy wasn't quite there yet in terms of providing consumer durables, but it mobilized very quickly for peace. And you can see that inflation came down, led by consumer durables. This was the also consumer durables inflation issue with the problem we had with supply chains. There was also obviously the rent inflation issue, but it's come down quite a bit. We're not at 2% yet, and the Fed's already telling us that when they get confidence that we're heading in that right direction and it's going to be sustainably down there, they might start to lower interest rates. Again, they raised in this summary of economic projections. What did they do? They raised their outlook for real GDP. I think they raised it from 1.8% to 2.1%. Don't quote me. I think it's something like that. And they slightly raised their inflation outlook, and yet they're still in the SEP. They're talking about three rate cuts. I think they don't really need to cut rates, but my job isn't to tell you what the Fed should do. My job is to tell you what I think they will do. And right now, I think they're certainly inclined to lower rates, but I'm still thinking maybe 2. I kind of doubt 3, and maybe those 2 will be after the election. But there are people who obviously disagree with that. So, this thing can all still blow up. What could go wrong for PMMT is this idea that, if we don't get a financial crisis, the credit crunch, we don't get a recession. Well, history has shown us that there's another way to get a recession, and that's with energy shocks. Energy shocks that cause inflation to go up, that force the Fed to keep monetary policy tight or tighten further. And this is what happened back in the 1970s. So I've seen people draw these charts showing the current inflation situation and say we're like about here, implying that, if history repeats itself, we're going to have another one. And certainly there could be another energy shock. And so that is something to worry about, think about, watch. And I am watching the price of oil, and it has been going up, which is why I think it's kind of strange that Powell seems so relaxed about inflation when certainly on a short-term basis, energy prices, price of oil is up like 19%. So something to think about. Wage inflation looks to us as though it's not going to be a repeat of the 1970s, barring another energy shock, which we don't think we're going to have. Let's move on here a little bit. So, what else could go wrong here for the Fed put obviously is getting everybody excited in the financial markets, and so as you can see, the S&P 500 market cap weighted all-time record high. It's been doesn't look quite like a vertical line here, but if you put enough history, you can make this look more vertical. And certainly we've seen even the S&P 500 equal weighted going to a new record high. Gold is at a record high. Bitcoin was at a record high. It's volatile, still extremely high ever since Bitcoin ETFs were launched on January 11th of this year. Home prices, this is single-family existing home prices we seasonally adjusted. It's a homemade seasonal adjustment here, and you can see we're at a record high there. So we've got a lot of asset prices really high, which is wonderful. The net worth of households is at an all-time record high of $155 trillion. The baby boomers have 75 trillions of that. A lot of people, I'm reading articles anecdotally that more people are concluding that they can retire now, maybe earlier than they thought, because they've had such a nice windfall in their portfolio. So it's all good, except for the issue of valuation. And as you can see, this is the forward PE and the forward sales. The forward PE has gone up. There are different scales, of course. So we're at 21 on a forward PE basis. You'll notice that the forward PE did not go down into single digits during this bear market. And I think the reason it didn't is because we didn't have a recession. If we had a recession, then everything goes wrong in recessions. The revenues go down, the profit margin goes down, earnings go down, and the valuation multiple goes down and gets into the single digits. Well, this time we got to 15, no recession, and increasing confidence that perhaps the Fed is getting close to done. And here we are at 21. And of course, we have to factor in that the mega cap 8 are a relatively unique phenomenon where 8 stocks account for almost 30% of the S&P 500 market cap. And if that's not going to go away anytime soon, then the forward PE of the S&P 500 is going to be higher. It's not going to be that fair value 15 that we're used to talking about. Now, of course, things can change here. We know that the Justice Department's coming after Apple. We know that the European Union is coming after some of the mega cap 8 as well. And so, large companies attract politicians who want to get money out of them. So that may be an issue, but these are big companies with lots of lobbyists and tremendous amount of resources. So again, we'll watch how that plays out. Another sign that everybody's happy here and nobody's got a care in the world is the corporate bond spread, the high yield minus the treasury bond yield. This is the overtime moving average. I looked at it before and I thought I was looking at it wrong, but actually it is correct. The average is 471. The spread is 344. Happy days are here again. And you can see that in the sentiment indexes. The bull-bear ratio has been up above 4 for 2 weeks in a row. So that's a highly elevated area of level of confidence. And this is just the bear component of it. And the bear component, I think, is, it's the second lowest reading. I mean, let me see. Yeah, no, it's the third lowest reading on this chart going back to 1987. So there aren't too many bears, and if there aren't too many bears, who's left to buy is one of the thoughts of contrarians who look at this kind of as this kind of indicator. So, well, Max left us, but Bailey's still here. Okay, so sometimes Max hears all he wants to hear in the first 15 minutes, and then he just leaves. So I hope that's not what you folks do. I'm watching you. I can see how many are out there, and I appreciate that you stick with it. So let's have a look at some questions here. Let me put on the other glasses. Okay, Hans says, happy spring to you. Hans, I wish you the same thing. We've had a very mild winter here, and we'll see what kind of spring we have, but we're looking forward to it. Cactus, what are your updated thoughts on the geopolitics here? Brent is up to 87 here. How likely and at what level of oil spoils the Fed's-led rally in the stock market? Well, Cactus, the honest answer is I don't know. We are going to find out, and I am concerned. I would say that's one of the charts that I keep showing over and over again, that we are seeing the oil price continue to move up. And I'm an amateur technician, and I think I've shown you that we're getting close to some breakouts of some downward line. But I mean, from a supply-demand perspective, we're still producing at a record amount of oil of 13 million barrels per day. I still think China has got a recession, and as does Europe. So I'm not seeing signs that the global economy is picking up, though. Copper's been up recently. Some of the commodity prices have been up, and some people are. I think Wilson over at Morgan Stanley is talking about a commodity price surge. At least that's what they told me when I did my interview on Bloomberg this morning. But I think it's if you're looking for what could go wrong, it's staring you in the chart there. If we get a spike in oil prices because something goes very, very, very wrong in the Middle East, because so far it's just gone very, very wrong. But clearly things can get a lot worse. Paul, as always, thank you. Ed, can you help reconcile the forces of monetary and fiscal policy that seem to be working against each other, and are there consequences to consider? Let's see, it says note the following, but I don't. Okay. So that's an excellent question. Yeah, I mean, the monetary and fiscal policy during the pandemic was like driving a car with both feet on the accelerator. Monetary and fiscal policy were extremely stimulative. And then over the past 2 years, it was like driving a car with, slamming on the monetary brakes and slamming on the fiscal accelerator. And it's amazing we got through that without any real calamity, quite honestly. And maybe that's because even though the government bond market is so huge and continues to get larger, there's still a lot of wealth being created, and people want to invest in government securities. So so far the fiscal excesses haven't really collided with the monetary tightening, and now monetary tightening is over. And meanwhile, when it comes to the fiscal side of things, it has been stimulative. It's one of the reasons we didn't have a recession. I've been pointing out that sure, we've got like $800 billion in interest expense now by the government, but keep in mind somebody's earning that, and that's an outlay. It's a stimulative outlay, but it's hard to imagine how these things keep going without something having to change. One last question here, Paul again. Oh, that was a continuation. Fed funds rate moving to less restrictive QT, moving to a less restrictive QT, moving towards restrictive policy. I don't know if we're moving towards fiscal policy restriction. I mean, I don't see that. We've still got a lot of built-in stimulus in all the Biden bills for providing tax incentives and even grants for onshoring. And then we're still building and rebuilding a lot of infrastructure. So fiscal policy looks to me as though it still gets slamming on the accelerator. And that's why I think, I'm not rooting for the Fed to cut interest rates here. I think rates are probably where they should be. And I think if they cut them, we could very well have a melt up in asset markets. And then what? And so, when it comes to the 1990s analogy, I've been looking at the 1920s analogy, been looking at the 1970s, 1990s, and the 1990s analogy. I hope we're still kind of around December 5th, 1996, which is when Alan Greenspan asked, how do we know if we have irrational exuberance? But things happen a lot faster these days. So make sure you tune in to my weekly conversation with you, and so we can share thoughts. And appreciate the emails that I get from you folks, and look forward to our ongoing conversation. And we'll see whether Max is right or not. Max is bullish. Thanks, everybody.